Sarah and Mark huddled over their kitchen table, surrounded by receipts and crumpled tax forms. Their first tax season as new parents to baby Lily was proving challenging. Mark sighed, pointing at the final number. "I don't get it, Sarah. We spent so much on Lily's daycare, and my student loan interest. I thought all those deductions we heard about would make a huge difference. Our refund barely covers our coffee habit." Sarah nodded, a worried frown on her face. "It feels like we are missing something big." They weren't alone. Like millions of Americans, Sarah and Mark understood that saving money on taxes involved things called deductions and credits. They just didn't grasp the crucial, dramatic difference between them. This misunderstanding, this blurred line, often costs people hundreds, even thousands, of dollars. It can mean the difference between a comfortable refund and an unexpected bill. Today, we are going to join Sarah and Mark on their journey to bust 5 common myths about deductions and credits, and empower you to make smarter financial decisions. Mark's frustration was palpable. "I tracked every eligible expense, daycare, those new energy-efficient windows, even my student loan interest. My coworker swore deductions were the secret to a big refund." This is myth number 1, the belief that deductions directly lead to a huge tax refund, dollar for dollar. Many people hear deduction and imagine instant cashback. Let's peel back this layer of misunderstanding and see how deductions really work, and why Mark's expectations might have been a bit off. Let's bust myth number 1. A deduction is a specific amount the IRS allows you to subtract from your gross income to arrive at your taxable income star. Think of it like a discount coupon. Imagine your total income is $70,000. If you have $10,000 in deductions, your taxable income becomes $60,000. You don't get $10,000 back, you're simply taxed on a smaller portion of your earnings. It reduces the base amount on which your tax is calculated, not the final tax bill directly. Here's a simple analogy to make it stick. Imagine your gross income is a shopping cart full of groceries. Before you get to the checkout, you have a coupon for $10 off if you buy specific items. That $10 coupon, your deduction, reduces the total value of the items in your cart star. So, if your cart was $100, now it's $90. You then pay tax on the new, lower total of $90. You didn't get $10 cash back, you just reduced the amount the tax applies to. For Mark, his student loan interest deduction, while valuable, didn't directly translate into a massive refund. If he had $2,500 in student loan interest, that $2,500 came off his taxable income. For someone in the 22% tax bracket, that deduction might save them $550, $2,500 0.22, on their tax bill, not the full $2,500. It's significant, but it's not a $4 reduction of the tax they go star. This distinction is key to understanding your true tax liability. Hearing about Mark's deduction realization, Sarah chimed in. "So, what about those credits everyone talks about? The child tax credit, the dependent care credit. Those are just like deductions, right? But probably bigger, like a super deduction." This brings us to myth number 2, the idea that tax credits are essentially just larger, more impactful versions of deductions, operating under the same fundamental principle. This is a common and costly misconception that truly blindsides many taxpayers. Let's bust myth number 2 with a bang. A tax credit is dramatically different from a deduction. Instead of reducing your taxable income, a credit directly reduces the amount of tax you owe dollar for dollar. If you owe $3,000 in taxes and qualify for a $1,000 tax credit, your new tax bill is $2,000. It's money off the final price, not off the subtotal. This is why credits are often so much more impactful for many families, especially those with lower or moderate incomes. Back to our shopping cart. If deductions are like a coupon off the items in your cart, then a tax credit is like getting cashback after you've paid the bill. Imagine you've paid $100 for your groceries, including tax. Then, you get a $10 rebate or cashback reward directly in your hand. You've already paid the tax. Now you're getting a direct refund of some of that payment. That's the power of a tax credit. It's applied after your tax liability has been calculated. For Sarah and Lily, the child tax credit could have a huge impact. Let's say they qualify for a $2,000 child tax credit. If their tax liability was initially $3,000, that credit would directly reduce it to $1,000. That's a direct $2,000 reduction in their tax bill, not just a reduction of income subject to tax. This realization was a light bulb moment for Sarah. So, if we had focused on qualifying for credits, our refund could be much bigger, she exclaimed. Exactly. So, let's visualize this core difference that Sarah and Mark are starting to grasp. Deductions reduce your taxable income star. They lower the base amount that your tax rate applies to. Their value depends on your tax bracket. Credits directly reduce the amount of tax you owe star. They are a $4 reduction of your final tax bill. This distinction isn't just a technicality. It's the fundamental difference between saving a percentage of your tax and saving the full amount of the credit. Armed with this new understanding, Mark looked over his student loan deduction. Okay, so deductions aren't cash back, but they still save us money, right? So, getting a $1,000 deduction is always worth the same amount as any other $1,000 deduction. This brings us to myth number 3, the belief that the value of every dollar deducted is the same, regardless of your income or other factors. This often leads people to undervalue certain deductions or overestimate others. Myth number 3 busted. The value of a deduction absolutely depends on your marginal tax bracket star. Let's define that simply. Your marginal tax bracket is the tax rate applied to your last dollar of income star. The more you earn, the higher your marginal tax bracket typically is. A $1,000 deduction for someone in the 12% tax bracket saves them $120. That same $1,000 deduction for someone in the 24% tax bracket saves them $240. The deduction itself is the same amount, but the actual tax savings differ significantly. Imagine Mark and Sarah are mostly in the 22% tax bracket. A $1,000 deduction for them would effectively save $220 in taxes, $1,000 x 0.22. Now, if they had a fantastic year and moved into the 24% bracket, that same $1,000 deduction would save them $240, $1,000 x 0.24. This is why wealthier individuals often benefit more from deductions, as their marginal tax rate is higher. It's not about the deduction itself being different, but the rate at which your income is taxed. As Sarah and Mark discussed the new energy-efficient windows they installed last year, Sarah wondered, can we claim those as a deduction and a credit? Or do we have to pick one? I heard something about being able to choose for certain expenses. This leads us to myth number 4, the belief that you can always choose between taking a deduction or a credit for the same expense, or even double dip. This area can be particularly confusing and lead to missed opportunities or even incorrect filings. Busting myth number 4. Generally, you cannot double dip by claiming both a deduction and a credit for the exact same expense. The IRS prevents this. However, some expenses might qualify for either a deduction or a credit. A great example is higher education expenses. You might be able to deduct student loan interest, a deduction, or claim an education credit like the American Opportunity Tax Credit or Lifetime Learning Credit. You must choose which one benefits you more, as you can't usually do both for the same qualifying costs. Let's consider Sarah's continuing education course. She might be able to claim a Lifetime Learning Credit, which is a credit, or potentially deduct unreimbursed employee expenses, though this is less common now after tax law changes. The key is to run the numbers. A credit generally provides more direct tax savings. If the credit is worth $2,000, that's $2,000 off your tax bill. A deduction for $2,000, in the 22% bracket, only saves $440. The choice is clear in this scenario. For Mark and Sarah's new energy-efficient windows, this is a credit, specifically the Energy Efficient Home Improvement Credit. It's not a deduction. This is a crucial distinction. Many people hear home improvement and automatically think deduction. But for these particular upgrades, it's a credit, directly reducing their tax liability. Knowing the specific nature of each tax benefit is crucial for accurate filing and maximizing savings. Looking back at their piles of receipts, Sarah frowned. We didn't have any big expenses other than Lily's daycare and Mark's student loans. So, I guess we don't qualify for much else. This is myth number 5. The belief that only huge, obvious expenses like a new home or major medical bills qualify for tax benefits. This myth often prevents people from diligently tracking smaller, everyday expenses that can accumulate into significant tax savings. Let's bust myth number 5. While big expenses certainly matter, many smaller, seemingly insignificant expenses can add up significantly, both as deductions and credits. For instance, the dependent care credit for Lily's daycare, while perhaps not big enough to buy a car, is still a substantial credit. Medical expenses, charitable contributions, even certain professional development costs, these can all be relevant. The key is consistent tracking and understanding what asterisk specifically asterisk qualifies. Even seemingly smaller credits can have a massive impact, especially for lower-income families. The Earned Income Tax Credit, EITC, for example, is a refundable credit designed to help low to moderate income workers. A refundable credit means you can get money back even if you don't owe any tax. This is incredibly powerful and can be a financial lifeline for many, directly putting money back into their pockets. Don't underestimate the collective power of these benefits. Sarah and Mark looked at their tax forms with fresh eyes. So, all those little contributions to our local food bank, the professional development course Sarah took, even the out-of-pocket costs for Lily's doctor visits beyond our insurance, these could all add up. Mark exclaimed. The confusion was starting to lift, replaced by a sense of empowerment. They realized that understanding these nuances wasn't just about avoiding mistakes, it was about strategically planning their finances year-round. So, what can you do to avoid Sarah and Mark's initial frustration? First action step, track everything. Don't wait until tax season. Use a spreadsheet, a budgeting app, or even a simple folder for physical receipts. Categorize your expenses as you go: medical, childcare, charitable donations, education, home improvements, business expenses. Knowing what you spent and where will be invaluable when identifying potential deductions and credits. Second action step, understand the eligibility requirements. Not every expense qualifies for every tax benefit. The child tax credit has income limits. The student loan interest deduction has specific rules. Energy credits require specific types of improvements. A quick search on the IRS website, irs.gov, for Publication 17 or specific credit or deduction names can provide detailed, up-to-date information. Don't guess. Verify what truly qualifies. Third action step, leverage tax software or a tax professional. Modern tax software, like TurboTax, H&R Block, or FreeTax USA, is designed to walk you through common deductions and credits. It asks targeted questions to help identify what you qualify for. For complex situations, a certified public accountant, CPA, or enrolled agent, EA, can provide personalized advice and ensure you're maximizing your benefits while remaining compliant. Don't be afraid to invest in expertise. Sarah and Mark realize that tax season isn't just a yearly chore, it's a culmination of their financial decisions throughout the year. True financial empowerment comes from tax planning, not just tax filing. This means making choices with an eye on their tax implications, like contributing to a traditional IRA for a deduction, or considering energy-efficient appliances for future credits. Every decision can have a ripple effect on your final tax bill. As Mark started researching, he stumbled upon another important distinction regarding credits: refundable versus non-refundable . This is where the impact can become truly dramatic. A non-refundable credit can reduce your tax liability to zero, but you won't get any money back beyond that. For example, if you owe $500 in tax and have a $1,000 non-refundable credit, your tax bill becomes $0. You don't get the remaining $500 back. A refundable credit however, can not only reduce your tax liability to zero but can also provide a refund for any amount remaining. This is the real game changer Mark discovered. If you owe $500 in tax and have a $1,000 refundable credit, your tax bill becomes $0 and you'll get a $500 refund. The EITC and a portion of the child tax credit are examples of refundable credits. These can truly boost your income. Sarah turned to Mark, a wide smile spreading across her face. So, that's why our friend Jane, who earns less than us, gets a bigger refund even with fewer deductions. She likely qualifies for larger refundable credits like the EITC. We were so focused on deductions, we missed the incredible power of credits, especially those that are refundable. The pieces were finally clicking into place, revealing a complete and powerful understanding of the tax landscape. Just like Sarah and Mark, you now have the tools to approach tax season with confidence. Remember, understanding the distinction between deductions and credits isn't about memorizing tax codes. It's about knowing how your money works for you. It's about empowering your financial future, one smart decision at a time. Don't let myths about taxes cost you money or peace of mind. Be informed, be proactive, and claim what you're rightfully owed. Let's quickly recap the 5 myths we busted today, giving you the real, concrete truth about deductions and credits. 1. Myth 1 deductions give huge refunds. Busted. They reduce taxable income. 2. Myth 2 credits are just bigger deductions. Busted. They reduce your tax bill directly, dollar for dollar. 3. Myth 3 all deductions are equal. Busted. Their value depends on your tax bracket. 4. Myth 4 you can always choose between a deduction and a credit. Busted. No double dipping. Pick one that benefits you most. 5. Myth 5 only big expenses count. Busted. Small, tracked expenses and powerful refundable credits make a difference. With their newfound knowledge, Sarah and Mark started sketching out a plan for next year. They'd set up a dedicated folder for Lily's daycare receipts, research potential energy-efficient upgrades with an eye on the credits, and Mark would explore options for a traditional IRA for an additional deduction. They felt less intimidated and more in control, ready to make their money work smarter, not just harder. This proactive approach brings true peace of mind. As Benjamin Franklin once said, by failing to prepare, you are preparing to fail. This rings especially true in the world of personal finance and taxes. Sarah and Mark's journey shows that even complex financial topics become manageable with a little patience and the right information. Your financial literacy is one of your most powerful assets, giving you the confidence to navigate challenges and seize opportunities. Don't let tax season be a source of anxiety. Instead, let it be an opportunity to learn, plan, and grow your financial well-being. By understanding the dramatic, personal difference between deductions and credits, you're not just saving money, you're building a stronger financial foundation for yourself and your family. We hope Sarah and Mark's story has inspired you to dive deeper into your own tax situation. You've got this. If this video helped you understand the difference between deductions and credits, please give it a thumbs up and subscribe to our channel for more friendly financial explainers. What tax myths have you busted in your own life? Share your experiences in the comments below. We'd love to hear them. And remember, knowledge is power when it comes to your money. Thanks for watching, and we'll see you in the next video.